Everyone, my name is Anastasia, and I'm head of Emerge Club, which is an exclusive open online membership for venture capitalists and startups from all over the world. And this is our first online event, online meetup on the topic of the state of VC market, what's coming next for founders and investors. And I'm happy to introduce my speakers, my guests for today. Godska, founding partner of Acrobator Ventures from Netherlands. Hi, Bas. Thank you so much for joining us.
Thanks for having me.
My second guest, my second speaker is Karén Gyulbudaghyan, founding partner of Strategic Value Ventures, ambassador and key advisor of UC Berkeley Skydeck, and founder of Ground Zero Specialty Coffee, the first and only venture cafe in Armenia and the region. And we discussed a little bit the topic of coffee before. Karén, hello, thank you so much for joining.
Thank you for having me, too.
So our topic for today is a really hot one, the state of VC market, because venture capital is experiencing dramatic fluctuations these days. And my first question for both of you is, what do you think, what's coming next for investors and for startup founders?
Will I kick off?
Yes.
Firstly, like I'm an angel. I have been for 20 years an angel investor, and angel investors are always extremely positive and bullish and happy. They have not much time for paranoia and black doom scenarios. So I try to take this spirit into the institutional environment of a VC fund, which is always very interesting dualism with my partners who are more about repeatability, sustainability. So we always find, I hope, some sort of ideal common grounds. So one snippet of information that I found while researching is that actually the VC-backed companies have a 37% increase from the previous quarter. So that in itself is good. And then I'm actually talking about Q1 of this year. So it's a bit late data, but that means that I can somehow sense with my gut feeling mainly, but there are some data points backing it up, that we have maybe gone already through the worst. Now, don't quote me on that in a year if for my future outlook is too optimistic, but I'd like to feel that we're heading to a slightly, mildly more neutral and positive area, step by step, quarter by quarter. One other data point I noticed is that I would say the almost penalty discounts that late stage companies have as on their valuations from the highlights in the last quarter of 21 are also decreasing. I see offers of 30% discount, 25% discount, whereas that would be in the kind of panicky half year ago, 3 quarters ago, 60% down. So of course on the stock market you don't always see that, but I don't look that much at stock market because our fund is mainly looking at pre-seed and seed. So I'm very carefully angel type style kind of positive of us surviving this winter and founders with us.
Thank you, Bas. Karén, what do you think? Recently, I read a really hot discussion about the state of VC market in one of the Telegram channels. And the author wrote that there is so much money on the market and no one knows when it's going to grow again. So what do you think, Karén? Do you agree or disagree?
Well, if we look at the market from early stage, let's look at the early stage, right? So pre-seed, especially where you primarily rely as a founder on investment from angel investors, right? So at least the data shows that for the past couple quarters, right, in 2023, at least based on PitchBook, there is definitely a big pressure. And the median deals are quite, I mean, really going down in terms of the size, the number, and it definitely shows a lot of uncertainty for early stage investors. I mean, in a way, I'm making some parallels when the COVID started in 2020, right? So you would see definitely a big decline in early stage investments because of the the risks associated with the deals, inability to meet with the founders, right, in person. So there was also a cultural change. So we passed this cultural change from the standpoint of, in a way, substituting in-person meetings with online meetings, or having it as part of our regular deals or, assessment, right? I mean, nothing in my mind will substitute in-person discussions and meetings with people. In that sense, I'm old-fashioned. However, when you look at deals which are investments over the past quarters in later stage companies, they're pretty much the same, or around the same. Definitely the economic situation, the rise of the interest rates, uncertainties in a number of regions, right? Creating a lot of pressure on investors and also on companies. I mean, the rise of VC deals, especially VC deals, was attributed to non-conventional, I would say, investors, or flocking from 2018-19, topping in 2021. Now there is some decline, and substantial decline. Roughly half of this, deal makers, VC deal makers, at least on pause, if not to say, are on sidelines, right? So that definitely creates a lot of uncertainty on the market. No one knows if this is the bottom, rock bottom, if the worst is behind us. However, there is also some sense of like what to expect, right? What to expect in the future. And if we look at the nature of the VC business, right? You can't really sit on the money forever. You need to move, you need to do something about this. So I would attribute this time to adjustment, adapting to new realities in a sense, right? Understanding or redesigning or reconsidering the strategy around this and start moving forward. So I would say I would expect more deals in the future. However, from the risk standpoint, from allocation between early stage to later stage, I think we're still gonna see some volatility.
Thank you. So what do you think is the crisis? You both mentioned the early stage. Is there a crisis in the early stage market? Is it more difficult for early stage startups to raise money now?
Absolutely. I mean, I'm in a position when I'm not only looking for the deal flow, I'm developing that deal flow for early stage companies. So in a way, over the past 5-6 years, I developed some ecosystem, cross-border ecosystem, when I'm directly and in some cases heavily involved with the founders. Not only mentoring, advising these founders, but also engaged in the process of business, developing the business, the product market fit, and definitely fundraising. So the state of the market is definitely not the best, especially for early stage companies. So the mindset of investors is changing. I will definitely mention that it depends also on the industry. Some industries being hit harder than the other ones. However, if we look at kind of efforts which founders now making to raise the capital. It's definitely much more pressure on their shoulders, and it takes longer time. I mean, I have at least 3 companies, at least from early stage companies in my portfolio, which are starting or in the process of fundraising already, and definitely they facing new challenges.
Thank you, Bas. What do you think about the early stage?
Well, when I look a few years ago, before COVID, our fund has as a thesis to invest in Slavic founders worldwide. So not investing typically in Russia, but if it's Slavic founders across the world with the background from Eastern diaspora, that's always interesting for us. And there was always this arbitrage element that the valuations were a bit lower because there was probably harder access to Western capital. Well, in a way for Russia, that's now still the case. But it was mitigated a little bit by the lower cost base. If you had programmers in Ukraine, that would be cheaper than in Silicon Valley. So nowadays, we are back from this overheated and in a way unreasonable peak. I know it's great for founders to have 0 traction, but already be valued at 30 million or something. So, but those holidays are gone. But I'm also not seeing that we're back at the kind of 2.5 million pre-seed level. So it's kind of 4, maybe 5, sometimes 6. So basically, valuation-wise, it's as if 2 people were madly in love with each other, the investors and the founders. And now they're both being a bit more rational. So I see that we invest slower. We have more time to take a look at things. Unfortunately, the kind of 10x, like 3x is the new 10x, or the 2x, let's say, is the new 3x returns. We take longer in our due diligence. In the past, there was all this FOMO as an investor, like, oh my goodness, we have 1 week to decide. There are 6 funds issuing term sheets, which is very tough to kind of have a normal, calm, rational discussion. But nowadays, although it is calmer, I also see that we get less deals done for some reason. It's maybe because in the past, when somebody had 1 million in sales per year as traction, that would be extremely cool. Now we would be looking, well, it's maybe better to be a bit more on the safe side. If somebody really has proven product market fit with a 2 million level per year ARR, that is the kind of calmer options. Plus, you get them pretty much offered at valuations not significantly higher than where in the past you would get the 1 million ARR startups. There's of course exceptions, but basically, so it is harder for founders to work. Definitely on the fundraising side, the emerging funds, they're in a pretty tough position if they're still fundraising right now. The ones that have dry powder can take it a bit slower. I still am, as I said before, optimistic that this will all get into a little bit of a faster spiral, but like a network effect on the supply and demand side, but that will maybe take a year or so. And on the IPO level, it's so sad at the end of the chain now with kind of ridiculously low IPO quantity. I think I have a number somewhere that's only like 18 or 31 IPOs in the first quarter of this year compared to hundreds a few years ago, so in the same quarter. So anyway, that's a long answer to your question. Yes, I agree with Karén, and yes, the valuations are under pressure, and it is maybe not to be called a crisis, but a cool down. But yeah, what do you do if you're a founder and you've got 3 months runway left? That it's not an easy time to be in.
I would add that in this particular market, I want to make a distinction between angel investors and also VCs. So the pressure is definitely on VCs a lot. So angels are on, in some sense on sidelines. They trying just to watch. They have, I would say, some luxury of extra time, taking slow, because they, at the end of the day, they invest in their own money. So in their sense, they're definitely much more rational, and they not looking at bigger, 10x like VCs are constantly chasing, right? So in that sense, angel investors are more flexible. And I think in that sense, they also more capable in from capacity standpoint and timing standpoint to adapt to the new market kind of realities. Let's also take into the consideration, like definitely there is a huge hype in AI. Everyone again is talking about his company's AI company, right? So that's I see this this particular trend or hype happened also a few years ago. At least on a selection committee for UC Berkeley Skydeck, and we do review. I mean, during the year, thousands of applications with hundreds of interviews from 100 countries. So there is definitely some sort of theme, right? When you see every second company is AI company with ChatGPT, for example, that's what happened 6 months ago. I'm sure more is coming. So just going through the noise and really kind of understanding where the noise and where is real opportunity is also takes time and requires much deeper and kind of better due diligence on the investor side. So from the pace standpoint, I would not expect the deals to be fast. I mean, it will take longer time. There is more requirement from investors to founders to, to prove certain points, to provide not only proof of concept, not regular traction, but if you even on round A, round B, kind of increase the pressure on what kind of revenue and type of revenue you kind of demonstrating. Putting an additional layer of complexity, recent scandals with big investments in companies which been clearly fraudulent. I mean, also not helping the whole market and the sentiment, at least on the market.
So you mentioned AI, and my next question is actually about it. So the recent boom in AI investments has done little to dig VC funding out of it whole, kind of. So why does it happen? What do you think? Are there any reasons to be positive about this boom in AI investments?
Bas, do you want to take this?
Oh yeah, I'll take it. I mean, when you look at the macroeconomic elements of VC funds and what is affecting their investing, I would say that you've got macroeconomic conditions changing, you've got the rising rates, you've got therefore VCs being selective, and there's also an overall decline in LPs funding the funds. So then all of a sudden there's this nice little new gizmo, which is AI, that can be an extreme disruptor. It can transform decision making, it can increase success rates and reduce risk. So like already when you look now in our call, there's I think 3 or 4 people that have a note taker making notes of this call. Now, for instance, that was something that was my first AI triggered investment 2 years ago to create that. We're actually going to launch it finally in public beta coming weeks. But basically, I would say our problem as VCs with the whole AI thing, and then I'm just talking about us pre-seed seed stage, we also saw a spike, just like Karén, in the decks that all of a sudden have AI all over it, and everybody that was IO is now .ai, etc. So there is a hype element in this, but there's also extreme difficulty. Firstly, you've got the companies that have already been investing their pre-seed or seed money into AI development before October last year when ChatGPT hit our shores. And they actually often can throw away their parts of their products, parts of their development. And a lot of the founders that I've seen and spoken with, they were completely shocked and paralyzed on this. One of them made a beautiful metaphor saying, well, we're sitting here on the Titanic and our investors are still saying how beautiful the deck chairs are, etc. But we already see the iceberg coming. And some of them even said, like, it's a pity that we already raised money. We actually would now like to take half a year with a bag of popcorn to see where Google and Zoom, etc., are going before we start implementing our own adjusted product strategy. And the other element that is an issue for us is that when you start filtering, we have a PhD machine learning AI general partner in our team. We get hundreds of decks per month, and we need to shift the bullshit from the reality. And we also need to make sure that it's not a thin layer on top of ChatGPT. That is completely, not a case. It's more, what are you buying into as an investor? If it's just a small application tapping into ChatGPT, then you need to have an extreme user distinction or an extremely sticky user base. So it's hard. You cannot just say that anything in AI will be great. Maybe you should be looking at quantum computing, but that's not really in our thesis. And that needs the bigger bucks, of course. So I would try to summarize that AI is maybe very good for the absolute huge players, but in the early stage, it's very hard to make something that is fairly autonomous. Maybe you should sit on a lot of protectable data that you can start monetizing, or marketplaces in that field. That is a good venture case, like the picks and shovels. But just having a nice layer on top is very hard to defend in the long run. And you've got all these decacorns, kind of Google adds, Duet now to its workspace functionality. Zoom has got integrated note-taking, things like that. So it's interesting times now, and I'm not sure if there are many AI startups that can actually overcome that part, that they're just a tiny layer on top of ChatGPT. I'm very happy to hear otherwise, but that's what we've seen. Yeah.
Yeah, absolutely. I mean, same. I would say when I advise companies, when they approaching me for advice or just on a regular basis, mentoring, the first question I ask, whatever your not only idea, but the product which you're developing, number one, is this really a product which you're developing? Is this standalone product which you can build a company around it, right? Or it's just a feature. So many other companies, I mean, taking the same advantage, I mean, what's your arbitrage in this space? Are you just saying, I have extra feature which can be implemented in existing solutions already? Or you have something very unique in a sense, right? Something differentiating as a product. So that's number one. Number two will be, okay, you have something special. You probably utilizing, taking advantage of same ChatGPT, for example. But what's defensible about this? Why should I invest in this, right? What kind of barriers or what kind of moat you have essentially around this? So it will be relevant in the next 6, 12, 18, 24 months, right? Because, you know, in the next 6 months, the same ChatGPT may take into, you know, account many imperfections which they had. It will be much smarter in a sense, right? So whatever you're developing, number one, is it going to be relevant? If it's still relevant, what about your potential competitors? I mean, is it going to be easy for them just to pour extra money, extra resources, and, you know, take over? So defensibility, differentiation, and defensibility are two major things which unfortunately many founders are not even considering from get-go, and they should.
Talking about the deal flow and the situation in general, you personally, did you invest a lot, like in the past year? Because there is an opinion that in the past 1.5 years, investors are a little bit afraid of investing because of the fluctuations and everything. So could you please share your personal experience about the investing in the recent times?
Okay, shall I start or you, Karén?
Sure, go ahead, Bas.
I'll be brief. So we have done a little bit less quantity-wise deals, but it's definitely not because of some sort of scaredness. Let's face it, we have raised our funds through COVID. We did our final closing, I think, in July last year. So we sit on dry powder. We've spent half, and we have an investment period of, I think, 4 or 5 years, but we probably need 1.5 to deploy the rest of the capital. That's including follow-ons, etc. So I would say that for us, it's even a little bit better because that heated area got us very worried for a fund strategy that where we thought, okay, we're going to get $30 million into 24 startups. And then all of a sudden, all these valuations went through the roof after COVID or during. We kind of had to slightly readjust our fund strategy because you, as a VC, you need to make sure that you got a particular quantity, particular average check, things like that. So now with the things cooling down, we actually have a more rational discussion about valuations with new opportunities with new funds. But somehow operationally, maybe because now it's been a hot summer and startup founders also don't really fundraise that much during summer for some reason. So I don't know why, but our deal flow was a little bit slower. Of course, also deal flow from Ukraine, I think, is a bit under pressure. People are getting tired. The resilience is a bit, yeah, or maybe they look more at domestic funds. I don't know, but I'm very much inviting any Ukrainian founder to also take a look at our site. Actually, sorry. Oh, somebody got excited. Okay, but so as I promised to be short, I say that we are still very steadily progressing and we will not slow down. But we have a little bit less pressure on our shoulders to perform. So definitely I agree with what Karén said at the beginning. I mean, as a fund, you need to proceed with what you've been recruited for by your LPs. You need to invest the cash. We just take it a little bit slower, but we're not stopping. We're not afraid at all. Actually, it's a best period to be investing in a downturn because our exits will all be happening in 3, 4, 5, 6 years from now. So that meant that we could purchase our shares in the fine companies around better. And there's always this perpetual example of Apple being started in a downturn. So founders be happy and enthusiastic that you'll survive this as well. And Peter Thiel about AI said that actually the people that are now jumping on the ship for AI, they actually could be the ones disrupting all the existing players in particular areas because they have to carry this legacy around. If you had a huge tutor network or marketplace for tutoring, then if you were a newcomer and you make very good ChatGPT avatars, etc., then you have a chance to hit growth rates bigger, faster. But of course, you can be captured by the old players being at some point ready to convert their customer base to AI anyway. So it's not that Peter Thiel probably has 100% of the cases right, but it was interesting to think about it, that there's actually huge opportunities for founders now to disrupt the previous generation.
I'll share my observation from number one, from the deal flow standpoint. I think there is not so great news for founders specifically. And the reason is precisely what I mentioned, for example, in AI space, the barrier of entry is so low. You don't need to develop the entire stack. You don't need to develop everything pretty much which you're supposed to do in the past. You just putting extra layers. So that creates much bigger deal flow. I mean, from early stage companies. Even on the later stage, for the later stage companies, they've been optimizing, they've been trying to cut, to extend the runway for over a year now, but they're getting to the critical point. So they have a pressure to raise funding, right, at this point. So it creates a lot of pressure on companies and company shareholders, definitely, and also prior investors to find and fund the company. So from the deal flow standpoint, I think there is actually increase, right? Right now, because everyone is looking for funding. I mean, not to say that, especially with early stage companies, the quantity doesn't mean quality. So investors need to be very careful with this. When it comes to my specifically personal approach on investing, I have a little bit unique kind of value proposition or approach for companies. I'm investing in companies where first I know there is value I can contribute to. So I'm involved with the company founders, at least development, either advising them or supporting them. And I have extensive period of time to getting to know founders, right? In the past, I would say 3-4 months, I made at least 2 investments. So that's so there is no slowdown on that side. But again, the approach I take is to provide what I describe as an environment of support for these founders, for the company to grow. So it's not a typical, at least the VC approach, right? So engage heavily with and support these founders, and also in my case, be a strategic investor, at least join the investment with others as a strategic investor.
Thank you. And my next question is, what do you think, which are the next hot topics, like AI, and the next, what do you think, what's going to be the next?
Look, as much as we love to talk about AI, you know, more and more I'm starting to pay attention to not so sexy kind of industries or companies, where there is focus on improving, kind of increasing the or industries where tech or technology will provide much bigger opportunity, optimizations, and you know, better cash flow. So that's my focus, at least it's been over the past months as well. So looking for the opportunities where it doesn't have to be AI, because again, in reality, when we're talking about AI, there is 80 to 90% of the time, it's not really what AI is supposed to be. I mean, I have a math background, so it's a little bit easier to understand what AI is and what it's not. So, but from opportunities in developing companies are quite broader than just AI space, right? I invested in companies which are in AI space, which are in biotech, which are you know, in marketplace, in platforms. So I'm looking broader, right? In a way, I'm generalist, but like I mentioned, the key differentiator or key kind of factor for me, how much and how long can I provide personally value to these founders, or through my network, or through my, you know, team and expertise and many other things.
Okay, I'll come with my little list. When I look at what gets us excited, and also things that we may be excited about, but are not in the thesis of our fund, I'll start with one that is not in the thesis. I still believe that in IoT hardware, there's interesting developments. We don't invest in it, but things are still speeding up a bit there. But of course, cybersecurity, and also on the firmware level, is sexy. We've already invested in that. I say that when you look at the whole population on this planet and everything, then of course two things also on a macro level come to mind, which is health tech, and I agree, like biotech, even computational biology, biotech. But basically, that's one thing. Like, let's get this species of human beings a bit better helped through also quantum computing and AI, scanning genome, finding cures for cancer. Again, something our fund is not investing in. We are investing in, I would say, the infrastructure. So if it's data management platforms for this area, then that's in our realm, but we don't do biotech. Climate tech in itself is still in its early stages. And when we look at the weather across the world every day, then, well, unless you wear an aluminum cap and you believe that it's just a coincidence, then I think the need for mankind to be investing in this area and breaking through certain lobbies and things is good. I think another one that's probably the last one I'm going to mention now, but looking at decentralized web services, that could be something that either will hit the mark or not. That's kind of where in venture you take certain calculated risks. So I would say that that's roughly it. On B2C side, for some reason, there is some sort of overall saturation. That's a pity because I love B2C. I've been 20 years of a marketeer, and that part is always the sweet spot. But it's harder to now find something impressive that is really solving a problem. I'm always open to look at it, but B2B SaaS predictable shit is what a lot of people, it's easier to find the venture case there. That's my little list.
Thank you so much, Bas. So before forwarding my virtual microphone to our listeners, I want to talk to you also about the exit opportunities and down rounds. So it seems like exit opportunities are in turbulent times. What do you think? Do we still have them? And which are these opportunities?
So at least from my portfolio standpoint, we haven't hit any down round yet. So I hope it will not be the case. And I'm saying this considering, again, many different steps which we take to improve and optimize, extend the runway for the companies, and definitely meet certain kind of thresholds or requirements which we now see on the market, right, from investor standpoint. And we understand there are more, I mean, I wouldn't call more conservative. I mean, that's not the right word. However, they definitely taking more caution, right, and asking more and more questions, which was not really the case at least a couple of years ago. So I can't really say from the experience standpoint, at least the recent one. Definitely the market sees more and more, I mean, and it's on the rise, the down routes, right? And it's never a fun conversation between the founders, the investors, and in general, the mental state of kind of founders is really impacting. And this is not a good development in general. When your founders are not in good space, when they're not grounded, when they're not performing, that means it's just they will spiral. Just it's may go even out of hand, right? So from exit standpoint, acquisitions are probably the best right now. IPOs are not, at least for my portfolio companies, are not on the horizon yet. Acquisitions are actually becoming more interesting, considering valuations are becoming more reasonable, or at least it hits the reality for both investors and founders. So I will see more discussions, at least around strategic partnerships, mergers, and acquisitions.
As a footnote, I can give some numbers. There was this professor from Harvard Business School checking all the kind of exits opportunities and how much funding was IPOs were being made. And when you look at the first 6 months of 2021, there were 631 tech IPOs with proceeds of 149 billion. And when you look at the first half of 2023, there were 124 IPOs with 14 billion in exit proceeds. So that kind of shows the landscape quantified a bit. Yeah. And speaking more, zooming in from that field far away, zooming out from the IPOs back to pre-seed seed, I would say with we also have not seen down rounds, but also don't forget that people were sitting on some runway as a founder and also kept likely growing their business. So you saw often that the kind of punishment of a discount could be partially or fully absorbed by the growth of the company, so lower multiple, but still kind of staying on track a little bit. And then, of course, now what you do see is a lot of bridge rounds. So with bridge rounds, you can maybe, how do you say it in Russian? Уходить красиво or something, right? You can kind of, it's not like you put the snooze button a bit and hope that things will be better. And investors are often very clearly willing to support in this. And in the pre-seed or seed stage, you also see that there's still some of the, you can still get like little flocks of angels on board to kind of temporarily be attracted for closing some gaps where maybe the VCs are hesitant, which actually brings me to a small point, maybe a small sidestep, but I get more and more proposals, suggestions for innovative fundraising structures. There's a lot of hybrid accelerators coming up, accelerators, angel syndicates, people setting up special purpose vehicles on an ad hoc case-by-case basis. So that actually shows the democratization of the smaller investors getting more and more into it. Of course, in the States, you've got angel.co for ages. I even, as a fund, one of our first investments was in a Dutch, German, Swiss angel equity crowdfunding platform. We're bullish on this, and you even see groups that are now consolidating these types of business to maybe get it into some sort of private equity play, I don't know. So maybe there where a lot of VCs try to still calibrate the compass, this is partially absorbed by the more enterprising, less due diligence focused, or at least less extensive institutional due diligence focused angels or angel syndicates. I love that space. It's less rigid than the kind of semi-banking mindset you need to have in a VC. So that was a little sidestep about that development. I would say that that's one of the developments maybe triggered now a little bit more. But getting back to the topic of down rounds, I think, people cut costs. All the founders have drastically cut costs, had to let go staff, and counting their months. I've got a few startups that said, okay, since December, we as founders, because we're serial entrepreneurs, we actually stopped taking wages from the company. The management team lowered their fees by 25%, etc. So there's all kinds of measures to now survive the storm. And I've seen as I said, no down rounds discussed. What I did see, and then I'll be quiet again, basically in my angel portfolio of startups that I've got 45, 50 angel investments from before the fund. And there I do see a spike, a sad spike, that now companies that were already a bit struggling, that's a numbers game, of course, you can't have them all as winners. They really, I think one or two died. Yeah, two died in the last 3-4 months. Companies, not the founders, thank goodness. Some are really now becoming very inventive to survive. That all of a sudden this discomfort creates funky new ideas. And you also see that we as a hands-on fund in our portfolio, we seem to be fine. Like we did very defensive, very careful, a bit conservative investing. This is our first fund thesis fund in this capacity. So we want to do everything really well. So this duality I was talking about of risk aversive and my perpetual optimism. It's kind of still, with 4 general partners, we kind of do fairly careful investments. So we did not go down in value of our portfolio, whereas the big funds, they are at 30–40% down. But yeah, we really now work harder. We have more board meetings. We support founders with all kinds of topics that were maybe less relevant before. So we even see pressure on the founders sometimes themselves, that where in the beautiful honeymoon days everything was fine, and all of a sudden when things get hard, some founders actually don't work that well together and make decisions to find other solutions.
Thank you, Bas. So I'm gonna ask the last question about down rounds. What do you think? Can startups correct their valuation and get back to work without fear of the negative PR? So you mentioned that some founders are afraid of down rounds. So what do you think? Will it be easy for them to go through this down round thing and go forward?
I'm happy to say something, but I've been talking so long that
Go ahead.
correct me if you're, yeah. I would say what I've seen is certain very sportive approaches where founders were, for instance, getting some of their stock returned in a actually there was one angel down round and but there was a force majeure element there. They were very sportive. They said, you know what, we fucked up. We're going to give a part of our stock back, but if we bring the business back into very healthy growth, then we'll get a part back. So that was an interesting structure, not really a down round, but founders saying in this particular case that because they were more to blame on some overlook, they solved it that way. Employee stock options to reduce wages, increasing that a bit has been, so basically cannibalizing the cap table a bit. Actually exceptions made by investors who on paper, with all these caps falling down the drain, have the right to take a big chunk of the round or of the cap table, actually saying, you know what, legally we have the right, but we understand that you will be less motivated. Let's find a fair way to kind of not live through the letter of the contract, but through the soul, because it's a hard, long journey for all of us. So that has been, I have seen that. Those are 2 or 3 examples where it's all about a bit of creativity. If you really ask me about some sort of mathematical approach, I would say just try to first cut costs and see how you can have a better negotiation position towards new and existing investors by knowing that it's not like in 1 month or in 3 months you have to put the light out. So it's maybe easy to say, but yeah, those 3 flavors are what comes to mind when we're speaking about solutions for founders.
I mean, every crisis, by the way, or these challenges bring also some, I would say, silver lining in a sense that it's a way to also test commitment level. Commitment from both founders, from investors, and also the employees, right? I mean, it's not uncommon, at least with my portfolio companies, when people are essentially putting a lot of sweat, not money, I mean, even volunteering their time with the expectation that things will turn around and, you know, funding will come in. So it's a good, I would say, time to do this testing. I mean, stress test, as they say. Another thing which I've seen, reconsideration of, for example, going from X round to next round, and instead calling we need extra bridge, or let's call it extension of the round A, instead of doing kind of full round. So there are definitely discussions in a lot of creativity, which I've seen also. Not necessarily everything will fly, at least when you put on the table and discuss on the board of director level. However, I mean, as I say, if you don't ask, you don't get. So it's an opportunity to test waters, to push the envelope, and this is actually a good time for that.
Thank you so much. So we have questions coming in the chat. So the first one is, what's your most exciting deal this year?
I have actually two. Yeah, so I'll just definitely as a qualifier, I will say I'm not investing if I'm not excited. So every deal I'm investing, I'm excited about the deal. The most recent ones, I would say the first one is Sama, the company which invented pretty much pioneering adaptive video, speed technology, which is on the crossroads of cognitive science and data science, and essentially taking it's quite exciting to see that this type of technologies are coming from the paper into life and really making a difference. And the second one, it's called Metaport. Metaport is a really unique idea, which is in a sense, I call it, it's about preservation of history, culture, democratizing the legacy living. At the same time, it's a huge opportunity. It's about storytelling, how you build the new future, like even metaverse, right? If you're building without any past, without any knowledge or history or culture, it's going to be empty. It's not going to fly. It's not going to be, place where you want to spend time. It's stickier when you, go to the basic level of your humankind and starting ask questions. And this is essentially the platform which allows to do that. So yeah, it's quite exciting times.
Thank you. Bas?
Yeah, firstly, I have invested a lot of my time in my charity foundation, Netherlands for Ukraine. So in a way, my time investments, the most, unfortunately, a very sad cause, but the fact that we've attracted millions to be helping people being wounded and being void of their house. So that I would say on a karma level is my most exciting investment. Then there is my cap as a private investor, not through the fund, because we as a thesis, as a fund, we can do investments with valuations up to 20 million, maybe 25. That has to do with Dutch taxation stuff and with our fund strategy. So it means that things above that, as a private investor, I do invest in, or things beside that where the thesis of our fund says that we don't do that as a fund. So I would say I'm excited about FinTech Farm. And FinTech Farm is a very cool, I would almost say like banking as a service joint venture approach in emerging markets. So setting it up in Azerbaijan, in Vietnam, just knowing that the founders are serial founders, they've set up a very, very successful leading neobank in Ukraine. And they do this all over the world with very strong execution. And for me, it's very exciting to see how that machine works, because you just create a conveyor belt of unicorns in every country where you have a lot of users starting to use your neobank services. So you provide already the platform, the credit card logistics, everything, the credit algorithms, and you work together with older legacy banks. Anyway, that's a long story, so I'm excited about that one. And another one I really like as a fund is, I would say, oh no, one more privately. Okay, now I'm going to do product placement, because everybody here with your note takers, Read AI, Supernormal, Fireflies, they'll be crushed now with carv.com, carv.com. Sign up there for a beta They're for free, so I think they will show some really interesting, I would say, note taker on steroids. You get video summaries, you get AI analyzed summaries. It's really cool. I just went out of the shareholders meeting with our quarterly update, and these are very strong serial founders. So that's with the cap of the private investor. Then I would say that an Armenian startup we've invested in, Binarly, they are very cool for understanding with world level knowledge what happens on the firmware level. We are with tens of billions of devices on this planet, if not hundreds, and basically so often already in the chips there is malware or strange things, and this company actually fixed that. I see that as a niche that could really grow extremely big, and it's already proven traction. But of course, as Karén said, I love all the startups we have in our portfolio. Maru is nice. Let's Enhance is great. Respeecher actually seems to be a bit like what Karén is saying. What I've really found extremely funky this week is that finally, Respeecher managed, it's a Ukrainian startup. They managed to do, they invited a Pakistani or Indian student to the studio, and they do real-time not translate, but kind of converting of his voice real time, so hardly any latency, into a female American voice. So he has a heavy Indian voice, and all of a sudden he speaks like a Washington lady. But also, I mean, they do funky stuff. So I love where they are heading, because with this you can disrupt the call center industry. They already do that. You can make all the drop rates of Microsoft support teams that speak with an unintelligible accent. You can make it all of a sudden almost pretty boring Oxford English, which helps, of course, for understanding each other. So I think that is a game changer. It's not text to speech or whatever. It's really kind of real-time elements. You've got a lot of robo-calling startups, etc., that have this type of adaptation, but there is like there could be 800 milliseconds or 1500 milliseconds delay. So I'm excited about that one, but now I noticed that was not one that we invested in this year, but sorry, yeah, so it was a little bit longer ago.
By the way, that's kind of a vivid example how competitive the space is from an early investor in Crisp AI. So which is pretty...
I'm backing them as well, but through S16. But I love that one. Yeah, that's cool. But they do more noise filtering, right?
I mean, it's more than noise filtering. It's more audio solution these days with kind of many features which you already described.
I love Crisp, yeah.
Thank you. Sounds really exciting. So we have 3 questions from Oktay. If I pronounce incorrectly, I'm sorry in advance. So please take the microphone and ask your questions.
Sure. Yeah, you pronounced it correctly, by the way. So what I was asking is, first, I have a unique position. I represent both my own company, who is developing products for other companies, integrate into them and act as their product and tech departments. And I also represent my clients, whom I work with closely, like their in-house teams. So I'm curious about VCs, and I never had touches with them. So I don't know how I should approach VCs in order to get into their networks and find good and more clients. And that's what I'm curious about, how I should approach that. And secondly, how I could get into their networks again to help them help broadcast my clients' projects and help them get their first investments.
I'll take the first part, as you take the second part, so we can go quickly. So first of all, before you approach any investor, especially VC investor, you need to really understand the mindset, and it takes some time to really understand even the different type of investors, like angel versus VCs, right? But when you approach the biggest thing which you need to take into account, when you pitch your company, you need to understand there is a big difference between good business, which you pitch, or investable business. it's quite different mindset in terms of the growth of the company, like what kind of return you can offer. I mean, the potential. You can't really promise any return on the investment, but definitely needs to be big market, needs to have really compelling problem and solution. You need to have differentiators, you need to have defensibility, as I mentioned. You also need to have good traction, and traction is quite broad depending what you do. One more thing, which you mentioned, you developing some, if I understand correctly, your studio, which develops kind of, or maybe even spins out these companies. Cap table will be a big discussion or consideration for investors. If, for example, you spin off the company from your regular, for example, outsourcing company, and on the cap table, you have 70%, for example, or 60% of your company, and the founders, other founders are less than 50%. It's definitely a red flag for investors. Don't even try to approach. I mean, no one will be interested from the VC community to invest. Bas, how should they approach investors?
I think because I see that it's two questions. Now I'm a little bit confused which one we're covering more, but if I'm adding to, I mean, we all can Google like what stuff is needed. So that list of Karén is very good, but you can still find other elements. I would say a referral from someone that is a mutual contact, unfortunately, helps. I think it was Andreessen from Andreessen Horowitz. When they asked him, did you ever invest in a startup coming from the street? He said, yeah, remember in the last 30 years, there was once that I did that. So it's always this social element that if there is a portfolio founder of the VC that you happen to know, a little warm intro is helping a lot. At the same time, for instance, our fund is very horizontal. We have one junior analyst at the moment. We've recruited one associate joining soon, but it's 4 general partners that vertically need to constantly work on all sides of aspects of the deal. So when you get 3,000 decks, it's a jungle out there per year. So it's still good if I get some sort of app like, hey, or LinkedIn message like, hey, we have a deck, etc. Ideally, you would immediately submit it in 1 minute through the website. You can even put a referrer field, the email address of the partner, and submit, because then it is in the CRM system and immediately it gets tagged which of us is best to look at it. If it's something that's really hardcore technology AI, it will go to Ramon. If it's something more into B2C, it will go, for instance, to me, or B2B SaaS. So anyway, so that part would help to make the life of a venture capitalist on the other side a bit easier, to at least suggest, for instance, you put everything in an app or in an email or whatever, but you can also say, well, actually, I've also submitted it through your website so that your analysts can look at it. That's a little add-on that I would say. And very briefly on the other thing where you ask about how to get the access to the networks, to get clients, there, look at the HubSpot approach. They say to funds, hey, if you are a partner with us, then your portfolio companies get 90% discount on the license of HubSpot for a year, and then 50% discount. That's something where a VC would be unfair if he doesn't pass on such a crazy, beautiful discount to the network. So normally VCs have this Telegram group or WhatsApp group where all founders are. And if you make it very easy to have some sort of snippet, some sort of small 2-3 phrases about the product, a discount link with a crazy discount, then it's very likely that a VC maybe asks you first a few questions because maybe it's not a good product. And if then it's okay, then they'll put it in the group and you'll see what the portfolio does. So that could be a nice approach, but make it a very compelling offer, I would say. Because if it's just like, hey, you get 10% off during September, then yeah, it's not going to move the needle.
Thank you so much. Both the cap table part and the HubSpot approach, they were enlightening.
Thank you. I think we have the third question from you, Oktay, about the Metapod.
Yeah, I don't know if I
Oh.
spelled it correctly, but I was curious about the vision you have about its future valuation and how it's going to make, how you think it's going to make money.
I don't want to take too much time, but Metapod is about collecting living stories from around the world and tagging to specific geolocation, stories which are pretty much mostly lost in family archives and not even family members everyone knows, but this is opportunity to make local knowledge, local story, a global knowledge. So think about this. These stories do not exist anywhere else other than people's mind or kind of papers. They do not exist right now on the internet. So you collect data points which do not exist. So you are, essentially developing a treasure trove of data which never existed on the internet. So in second part of this, when you have a storytelling, every story enhances, from the business standpoint, enhances your brand. Many brands, small to large brands, they have many stories, right? And more you hear about the stories, more you inclined and emotionally connected with the product. When I'm, for example, buying a hat, right? I have several options in the store or everywhere else. Why would I buy this particular one and not the other ones? Because I may have some, description about the product, or I have a person who made this, and this connection, this story helps you to move or make decisions, buying, liking specific brand. And this is just one opportunity to monetize. So, but if we look kind of further down in history, down in the future, more data points you have in the future, you're writing essentially a new history of mankind, connected. And this is where AI comes in.
Thank you.
Thank you so much. So it seems to me we don't have any more questions. Thank you, Bas. Thank you, Karén, for coming and joining the discussion. It was really interesting. Thank you, everyone, for joining us and listening. So I think we're going to announce the next talk recently. Thank you and have a good evening.
Thank you
for having us.
Thanks, everyone.
Thank you. Bye-bye.